You have spent years building a solid stock portfolio. You have carefully chosen companies that you believe in, and you have watched your investments grow. It feels good, right? But then, out of nowhere, market turbulence arrives. A major global event hits the headlines. Suddenly, your carefully built portfolio starts to shrink. Your gains begin to slip away. What do you do in this moment? Do you simply watch, hoping the market recovers? Or do you take action to protect what you have worked so hard to achieve? This is where hedging comes into play. Think of hedging as a type of insurance for your investments. You cannot predict the future. You cannot know exactly when the market might tumble, but you can prepare for it, and that is what hedging is all about. It is not about guessing the next crisis. It is about giving yourself a safety net so that when a downturn happens, you have a plan in place to limit how much it hurts. Before we get into how to hedge, let's explore why it matters. Consider a very real historical moment. Early in the year 2020, when the pandemic sent shockwaves through the markets, investors saw steep declines in a matter of days. Portfolios that took years to build were slashed dramatically. Investors who had hedged their portfolios, however, were not immune to losses, but they were able to soften the blow. They had strategies and tools that helped keep their losses manageable. Without hedging, many people found themselves scrambling, forced to sell stocks at poor prices or endure sleepless nights, wondering if their retirement plans were in jeopardy. Now let's talk about actual ways to hedge. One common tool is the put option. If you are new to investing, an option might sound complicated. But think of it this way. A put option is like a contract that says, no matter how low a stock's price goes, I will still have the right to sell my shares at a certain price. That certain price is called the strike price. By buying a put option, you are essentially paying a small fee, often called a premium, to guarantee that you can sell your shares at that predetermined price if the market tanks. Let's break down a practical example in detail, speaking slowly and clearly so you can truly understand the concept. Imagine that you own 100 shares of a well-known retail company, and each share is currently worth $50. You worry that the company's upcoming quarterly earnings report might disappoint investors and cause the stock price to fall. Instead of simply crossing your fingers and hoping for the best, you buy a put option. This put option might give you the right to sell your shares at $48 each. It will cost you, let's say, $2 per share for this right. Notice that I am spelling out the numbers as words for clarity. If the earnings report is worse than expected and the stock plummets to $40 per share, what happens? Without the put option, you would be stuck holding shares now worth $40 each, meaning you have lost $10 per share. With the put option, though, you can still sell your shares at $48 each. Yes, you paid $2 per share for the option and you still face some loss. But that loss is now only a fraction of what it could have been. Instead of losing $10 per share, you lose about $4 per share total. The difference between losing $4 per share and losing $10 per share is enormous when you consider a large position in a portfolio. This peace of mind can be priceless during uncertain times. Another way to hedge is with something called a covered call. This is often used if you believe your stock might not rise significantly in the short term. With a covered call, you already own the stock, and you then sell a call option against your shares. By doing this, you collect a premium up front. If the stock does not rise above the call option's strike price by the time the option expires, you keep that premium as extra income. If the stock does rise above the strike price, you might have to sell your shares at that price, but remember, you received that premium, which helps cushion any potential downside. This approach can be especially helpful if you are looking for steady income and mild protection, but do not expect the stock to shoot up rapidly. If you have a larger and more diversified portfolio, futures contracts can come into play. Futures might sound intimidating, but think of them as agreements to buy or sell something at a certain date and a certain price. With stock index futures, like futures on a major market index, you can essentially bet on the market going down if you think there is trouble ahead. If the market indeed falls, the profits on your futures position can help offset the losses in your stocks. Picture this. You have a broad portfolio tracking the market, and you decide to sell an index futures contract as a hedge. When the market falls, yes, your stocks lose value, but your futures position gains value, helping smooth out the overall hit to your total investment account. Now you might ask, when should I hedge and how often? Hedging is not about timing the market perfectly. You are not trying to guess the exact day or week when prices might drop. Instead, You are preparing for the idea that unexpected events can occur at any time. Maybe you hedge during earnings season when many companies announce their results and stocks can swing widely. Maybe you hedge when global economic uncertainty is high, such as during political tension, changes in interest rates, or times when financial experts seem particularly anxious. Or maybe you simply decide that once your portfolio grows beyond a certain value, you always keep some form of hedge in place as a standard risk management practice. Think of hedging costs as similar to paying insurance premiums. Insurance is not free, and hedging is not free either. Buying options costs money. Selling options might limit your upside potential. Futures could mean tying up some capital. But what is the cost of not hedging? If you never hedge, you might face the risk of large, sudden losses that can set back your financial goals by months, years, or even decades. By proactively hedging, you accept a small, manageable cost now rather than risking a huge loss later. For new investors, it might feel daunting. But remember, you do not have to hedge your entire portfolio at once, and you do not have to be an expert trader. You can start small. Try hedging a single position that you are particularly nervous about. Test how it feels. Understand what it does for your peace of mind. Over time, as you grow more comfortable, you can expand your hedging strategies. Also, consider that hedging makes you a more mature investor. Instead of reacting emotionally to market drops, selling at the worst possible time, or holding on to hope without any plan, you become an investor who is prepared for the storm. With a hedge in place, you can sleep better at night, knowing that a sudden headline or unexpected event will not completely derail your plans. You are not betting on disasters. You are simply acknowledging that the market can and will move unpredictably, and you want to stay in control of your own financial destiny. At the end of the day, hedging is about balance. You do not want to overhedge and pay too much for protection you do not need, just like you would not want to pay excessively high premiums for insurance that does not make sense. But you also do not want to leave your investments completely exposed in a world filled with uncertainties. Consider your comfort level with risk. Consider your investment goals and your time horizon. If your portfolio is meant to fund your retirement or help you achieve important life goals, protecting it might be worth the cost. As you move forward, think critically about what steps you will take to secure your financial future. If any of this sounds complex, do not hesitate to learn more. Seek guidance or practice on a smaller scale. The goal is not to become a hedging expert overnight. The goal is to understand that this tool exists and can be used to your advantage. If this explanation helped clarify the concept of hedging, consider sharing this knowledge with other investors. Give this video a like if you found it useful, and subscribe for more insights on managing risk, finding opportunities, and becoming a more confident, resilient investor. With the right tools and a mindful approach, you can navigate both calm and stormy markets alike, always prepared for whatever tomorrow may bring.